Good morning. Welcome to our virtual class in your subject ACTG 6153, and this is Fundamentals of Accounting, Theory and Practice. Today's discussion is on the week 3 module, and this is entitled Accounting for Partnership Operations. And I'm your professor, Susan Maminta from AMA East Rizal branch. I will now be discussing to you the basic concepts and accounting processes relative to organization or formation of a partnership. And this is on how to account and record the contributions or investment of the partners, the division of profits and losses, the partners' withdrawal, or drawings for personal use. So our learning objectives for you to be able to understand additional features of partnership, such as plurality of capital and drawing accounts, and profits and losses sharing of the partners. Account and record the partners' contributions to the partnership. Understand and apply the different ways of forming a partnership. Learn the different method of dividing the partnership profits and losses, and understand and account for partners' drawing account. In our previous module, we have cited the definition of partnership using the Article 1787 of Republic Act 386. It defines partnership as, by the contract of partnership, two or more persons bind themselves to contribute money, property, or industry to a common fund with the intention of dividing the profit among themselves. So two or more persons may also form a partnership for the exercise of a profession. So from the definition, we can extract the possible contributions of the partners. And these are the money or property, industry, or services. Now, plurality of capital accounts and drawing accounts. Each partner's capital account will be credited for their initial investment or contribution. For example, we have these partners A, B, C, and each one of them contributed cash, 100,000 each. So you will debit cash 100,000 and credit the capital account of A as 100,000, another cash 100,000 for the credit of capital of Mr. B, and another 100,000 for the capital contribution of partner C. So therefore, each owner or each partner of the partnership have their own capital accounts. For the capital or additional investment or the initial investment of the partners, you are crediting their capital account. While for a withdrawal of cash or any other assets of the partnership made by each partner, and this will be debited to his withdrawal account. So if we have capital account for each partner, we also maintain withdrawal account for each partner. And that is what we call plurality of capital accounts and drawing accounts. Additional account for a partnership is this partners loans to the partnership. There are some cases where a partner lends money to the partnership, and this is credited to loan payable or note payable of the business. So for the cash received from one of the partners, and this will be recorded in the partnership books, you debit the cash and you credit loan payable to Mr. the name of the partner. While a partnership loan to the partners, this is on the case where a partner borrows money from the partnership funds. So this is a debit to loan receivable or note receivable. So debit loan receivable to the name of the partner, and you credit the cash when cash was borrowed, or you credit inventory when inventory was the one used in borrowing, or you credit the other property of the partnership, if that is the property borrowed by one of the partners. Salaries of partners. Partners may allocate allowances or salaries to themselves. But take note, this is not the true business expenditures. This is usually a method of dividing profits. So don't be confused that this salaries of partner is not part of the expense of the partnership. This salaries of partner is being taken up at the time of distribution of profit or profit of the partnership. For example, class, at the end of the accounting or at the end of the accounting period, or if it is on the month, ending month for the financial statement, okay, the financial statement states that there is 200,000 net profit for distribution among the partners. Before distribution for that net profit of 200,000, and if they have that provision for salaries of one of the partners or all of the partners, then you have to deduct first these salaries of the partners before doing the distribution of the net profit. For example, 200,000 is the net profit, and then A and B have this agreement that they have to receive salaries 20,000 each. So that is 20,000 each, that is 40,000. So in effect, the remaining net profit to be distributed among the partners is only on the amount of 160. There is also a provision for interest on investment. Yet again, this is not a kind of expenses on the part of the partnership book, as this is also a way of sharing profit among partners. That means the interest can be based on initial contribution or the average capital or in the beginning capital or in the ending capital balances. This is just the same with the salaries of partners. But this time you are taking the investment of the partners or the total investment of the partners that you agreed, or the partnership, they agreed on that division of profit. So going back with our example that the 200 net profit is for distribution among the partners, and we got 40,000 for the salaries, and there is a provision of interest for one of the partners, let's say partner C, okay, that he is entitled for a 10,000 interest on his 100,000 investment. So you have to deduct that 10,000. So the remaining 150,000 is the amount to be distributed among the partners. So the profit and losses sharing of the partners, it can be in a fraction or in a percentage depending on their agreement. Okay? But if there is no agreement among the partners, so it is fairer to divide the profit based on their capital contributions. There are different ways of forming a partnership. One is two or more persons may organize a partnership to operate a business for the first time, and they contribute cash, or they contribute cash and other property, or they contribute cash, property, and industry. Okay, so for a cash, you have to debit the cash and credit the capital account of each partner. And if it is a cash and other property like furniture and fixture, okay, you debit cash and the furniture and fixture, and then you credit the name of the partner who contributed this furniture and fixture. Well, there is also a partner who has this contribution, cash, property, and industry. For a cash property, that this must be recorded or journalized, and taking the amount of cash and while crediting the name of the partner who contributed that cash. While the industry, that means the service, there is no journal entry of that, but there is a memorandum entry stating that this partner is a industrial partner, and he is not liable for any losses, but he must have that right to share in the profits of the partnership. And that should be clearly stated on how much will be his share in the profit. Another way of forming a partnership is that two or more persons to form a partnership whereby one or both of them are already in business. So our first example, these are on individuals with no business. While this number two, another way of forming a partnership, these are the persons who have existing business, and they agreed that they join together, or their business will be joined together. So there will be an agreement between the two on the new set of books to be opened, or either one of the existing books of the business will be used as the partnership books. So take note that in the accounting, there will be adjustments on the valuation. So another one of forming a partnership is admitting a new partner in an existing partnership. So that means the partnership is already in operation, and there's a new partner who wants to join the business. So the new or incoming partner will purchase an interest from one or more of the old or current partners. So for example, the existing partners are partners A, B, C, and now partner D is coming to join the business, and this partner B can have his capital by buying a part of the interest of the existing partners or will have a new investment in the business or make a new contribution to the business. While another one, okay, the incoming partner to purchase the interest of one or all of the old partner by investing in the partnership. That this partner D can buy all of the interest of the existing of some of the existing partners or only a portion of the interest of the existing partners. In the division of partnership profit and losses, these are the methods. They can share equally, okay, or they can share based on some arbitrary ratio or stated fraction. So if they have that one of the partners contributed 25,000 and the other one is 25,000 and the other one is 50,000, so they will have this 25, 25, and 50, okay, percentage. So while sharing based on capital contribution, okay, so as I have said, okay, if one of the partners has this 100,000 and the other one has this 150 and the other one has this 200,000. So the distribution of profit and losses will be based on their capital contribution. So the partner who has the highest contribution will have that highest percentage in the profit, but also highest percentage in the losses. A certain percentage of interest is allowed on capital balances and the remaining profits based on agreement. So if they have that agreement that the computation on the division of partnership profit and losses are based on the capital balances. Okay. That means we are talking here, what we are talking here is the ending balances of the capital accounts. Salary is allowed to partners and the remaining balance on agreed ratio. As we have discussed before a while ago, that salaries, if there is a provision of paying salaries, then you have to pay first the salaries of these partners before proceeding to the distribution of the income. And even the interest on capital, okay, salary allowances to partners and the remainder on agreed ratio. So after deducting all these provisions like interest, provisions on the salaries, provisions on the bonus, then the remaining will be distributed depending on their agreement. Okay, now let's talk more about partners drawing account. But we have discussed this a little a while ago, that the plurality of the capital account and the drawing account of the partners. Now, for the partners drawing account, partners also need cash for personal use expenses, just like the sole proprietors. And for that, if there's some partners who borrowed money or get money or even other assets of that, or we are talking here the cash, then that is allowed. And same thing that we debit the partner's drawing account and we credit cash for the transaction. But there is also withdrawal of non-cash assets, and that is also allowed. So for example, the partners withdraw inventories, merchandise inventories. Then you debit the drawing account of that partner and you credit the merchandise inventory. Now, for recording drawing is made by debiting drawing account and crediting cash or any other assets, as I have said a while ago. And there are businesses that close the balance of income summary to the drawing account, and then the balance of drawing account will be closed to the capital account. So here, class, okay, this is about the closing entries, right? In closing entries, remember in your accounting 101 that in closing entries, we have to close the all expenses accounts, all the revenue accounts. We also close the drawing accounts. So just to give you a little review, that in doing that, we are using a temporary account, and that is income summary account, or what we call ISA, or sometimes we call that RESA, revenue and summary account. Now, in the first closing entries is to debit, of course, the ISA, to debit the revenue and credit the ISA, the income summary account. And then for the expenses, of course, you debit the income summary account and you credit all the expenses account. And then all the remaining accounts or the balances of this ISA, because you have the debit entry and the credit entry for each ISA, the balances of this ISA will be close to the drawing account. And now the balances of drawing accounts, since you have that debit or the credit, then this drawing account will be close to the capital account. Okay, so that's it about partners drawing account. Okay, so this is the last topic in our discussion today, and I'm now giving you my last slide. And again, this is the end of my discussion, and class, thank you for listening. Bye.